Imagine history repeating itself, but this time the stakes feel even higher. Financial crashes are not just relics of the past 1929, 1987, 2008. Each crisis had its own trigger, its own trauma, and its own recovery. But right now in 2025, warning lights are flickering. Are we teetering on the edge of the next big crash? We're going to compare the past, unpack what made those crises so devastating, and ask, are we closer to another collapse than we think? Let's begin where modern financial memory truly starts. 1929. The Roaring Twenties had created an atmosphere of unstoppable growth. Speculation was rampant. Stocks were bought on margin, and optimism drowned out caution. Many bought stocks on credit. When the market finally cracked, the illusion shattered with it. During the Great Depression, the economic collapse was intensified by high leverage, weak financial regulation, and the constraints of the gold standard, which limited government's monetary flexibility. After the 1929 crash, a series of banking panics led to widespread failures, with roughly 20% of U.S. banks collapsing in the early 1930s. Unemployment risk and financial fragility were poorly understood at the time, and the banking system's weak capitalization left it especially vulnerable. U.S. unemployment ultimately soared to about 25% at the peak. Although some economic activity resumed by the mid-1930s, the recovery was slow and uneven, with many countries not returning to full strength until the late 1930s or even early 1940s. And as we move from 1929 into the next major crisis, pay attention to how familiar these patterns begin to feel. Because while technology and markets evolve, human behavior rarely does. Fast forward nearly 60 years, the world avoided another depression, regulation improved, and markets matured. Yet even with all that progress, 1987 showed that fragility still lurked beneath the surface. On October 19, 1987, global equity markets experienced a dramatic collapse, with the Dow Jones plunging about 22.6% in a single day. The causes were complex. Program trading, perceived overvaluation, heavy use of derivatives, and high leverage all contributed to the sudden breakdown. Broader macroeconomic concerns also played a role, including growing trade and budget deficits, rising interest rates, and a widespread sense among investors that something was wrong, a mood that closely mirrors today's environment. Surveys from the period show that many investors even reported a gut feeling of an impending crash, likely influenced by mounting debt levels. Ultimately, the crash served as a wake-up call for improvements in market structure and risk management. In the years leading up to the crisis, the conditions bore striking similarities to modern markets. Stocks were widely seen as overvalued, PE ratios appeared stretched, and many believed prices were too perfect. Leverage was common across investors and institutions, fueled by borrowing and the growing use of derivatives. National debt had also risen substantially through the 1980s, adding to systemic stress. Market sentiment mixed euphoria with underlying fear, sustaining a belief that prices could only move higher, right up until they didn't. What's striking is that, even after such a dramatic crash, the recovery was faster than expected, a hint that not every crisis unfolds the same way. But as we step toward 2008, we encounter a very different beast, a crisis built slowly, quietly from within. Unlike 1987's sudden shock, the 2008 crisis was a slow-motion avalanche. Years of easy credit, soaring home prices, and misguided confidence set the stage for one of the worst financial collapses in modern history. The 2008 financial crisis was rooted in the collapse of the U.S. housing bubble, where subprime mortgages had become widespread, underwriting standards were lax, and many borrowers were highly leveraged. These risky loans were bundled into complex instruments such as mortgage-backed securities and collateralized debt obligations, which were sold across the global financial system. When mortgage defaults began to rise, the value of these securities plummeted, setting off a rapid chain reaction. Financial institutions held massive exposures to these products, and as underlying loans failed, liquidity evaporated. The banking system's interconnectedness meant that the failure of some institutions quickly endangered others, leading to a global market collapse. Governments intervened with large bailouts and unprecedented stimulus measures, Yet the real economy suffered deeply. Millions lost their homes or jobs, and U.S. per capita GDP did not return to its pre-crisis peak until around 2013. In the aftermath, extensive regulatory reforms were introduced, including stricter capital requirements, mandatory stress tests, and tighter oversight. The pre-crisis environment shows several striking parallels to conditions observed at various times since. Debt levels had surged, particularly household and mortgage debt risks were widely underestimated, as many assumed that real estate prices could only rise. High leverage, combined with the rapid growth of structured financial products, amplified vulnerabilities, especially as investors failed to appreciate how correlated these assets could become. In a downturn, consumer sentiment was buoyant, fueled by optimism around home ownership, and a widespread belief that housing values would continue climbing indefinitely. And now we arrive in the present. This is where the parallels become harder to ignore. Across nearly a century of crises, certain patterns show up again and again. Rising debt, stretched valuations, and a sense of invincibility. Today, in 2025, those conditions are not only back, they're amplified. Global debt levels remain extraordinarily high, with combined public and private debt exceeding 235% of world GDP, according to recent IMF data. This burden is becoming increasingly difficult to manage as governments face rising interest costs. The era of ultra-low rates has ended, and refinancing existing debt is now far more expensive. At the same time, geopolitical uncertainty, ranging from tariffs to broader trade tensions, continues to rise while many countries run persistent fiscal deficits, leaving government financial positions increasingly strained. Policy space is also more limited than in past crises. Central banks cannot easily deploy massive quantitative easing without risking a rapid resurgence of inflation. Meanwhile, signs of speculative behavior have reappeared in financial markets, reminiscent of the 1920s or the late 2000s. Margin debt is elevated, risk-taking is widespread, and several asset classes exhibit frothy valuations. Consumer and investor optimism remains too strong in areas such as technology, growth stocks, and AI, even as macroeconomic risk increase and valuations stretch further. Concerns are gradually building around and questions like, what happens if interest rates remain high, or if heavily indebted governments struggle to refinance their obligations, are adding fuel to the apparent risks. These anxieties feed into a growing fear of large-scale refinancing stress. With so much global debt coming due, any further rise in interest rates or tightening of credit conditions could place severe pressure on both governments and corporations, echoing in spirit the vulnerabilities that preceded 2008. Given the deep interconnectedness of global financial markets, a sovereign debt crisis in one region could quickly trigger ripple effects worldwide. So we may not know for certain whether we're standing on the edge of the next major crisis. No single indicator can provide that answer, and crises rarely announce themselves in advance. Still, many of the essential ingredients are present. Unlike 2008, today's vulnerabilities are not centered on subprime mortgages but are far more systemic, rooted in sovereign debt pressures, geopolitical tensions, and widespread fiscal fragility. Central banks also have fewer tools at their disposal. Monetary policy is more constrained, and heavily indebted governments have limited fiscal space, as aggressive intervention now risks fueling inflation. A potential trigger might not be a single event, but a combination. A geopolitical shock paired with a credit freeze and a sudden rise in interest rates could quickly overwhelm the global system. And as you know, history does not repeat itself exactly, yet it often rhymes. Other memorable to history crises such as the dot-com bubble in 2000 or the COVID crash in 2020 also arose from different origins but shared familiar themes: leverage, excessive debt, speculative behavior, and a financial system stretched thin. In 2025, many of those same threads are once again pulled tight. Are we living in a debt bubble so large that refinancing pressure could unleash something far worse? Do markets underestimate the risk of sovereign defaults or a sudden liquidity crunch? And what happens when governments and central banks, limited by inflation and debt, can no longer act as decisive backstops? We may well be standing on dangerously unstable ground. The real question is not whether another crisis will come, but when and how severe it will be. What do you think? Is the next crash inevitable, or are we more resilient than history suggests?